Question 1. Which of the following is a key feature of a quota share reinsurance agreement? A. The ceding company retains a fixed percentage of the risk and the reinsurer assumes a fixed percentage of both premiums and losses. B. The reinsurer assumes all the risk above a certain threshold, with the ceding company retaining the lower portion of the risk. C. The reinsurance agreement covers only losses resulting from catastrophic events. D. The ceding company has no retention of risk in this type of agreement. Answer A. The ceding company retains a fixed percentage of the risk, and the reinsurer assumes a fixed percentage of both premiums and losses. Explanation: a quota share reinsurance agreement is a proportional agreement where the ceding company and the reinsurer share the premiums and losses in a fixed percentage. This type of agreement helps the ceding company to mitigate risk and allows reinsurers to diversify their portfolios. Option A is correct because it accurately describes how the sharing works. Option B refers more to an excessive loss agreement. Option C is incorrect because quota share covers all types of losses, not just catastrophic ones. Option D is incorrect because the ceding company retains a fixed percentage of risk in a quota share agreement. Question 2. Mr. Carter is an insurance company EO based in Vermont. His company has an agreement with an overseas reinsurer, but the reinsurer has not yet provided the required documentation for licensing in Vermont. What should Mr. Carter do to ensure compliance with Vermont's reinsurance regulations? A. Proceed with the agreement without delay since the reinsurer is based overseas and international treaties override state regulations. B. Ensure that the reinsurer submits the required documentation for licensing to the Vermont Insurance Department before proceeding. C. Have the reinsurer submit an indemnity bond to cover any potential regulatory issues. D. Cancel the agreement immediately, as overseas reinsurers cannot operate Vermont under any circumstances. Answer B. Ensure that the reinsurer submits the required documentation for licensing to the Vermont Insurance Department before proceeding. Explanation: according to Vermont state-specific reinsurance regulations, reinsurers must be licensed or approved by the Vermont Insurance Department to conduct business in the state, even if they are based overseas. This ensures that the reinsurer complies with local solvency standards and other regulatory requirements. Option is incorrect because international treaties do not override state-specific insurance regulations. Option C suggests an indemnity bond, but it is not a substitute for proper licensing. Option D is incorrect because foreign reinsurers can operate in Vermont if properly licensed and authorized. Question 3. Which of the following is a key risk management tool that reinsurance companies use to limit exposure to extreme loss events, such as natural disasters? A. Risk retention limits, which allow a reinsurer to retain a higher portion of the risk. B. Catastrophe bonds, which allow a reinsurer to transfer risk to the capital markets. C. Reinsurance recoverables, which are the payments made by a ceding company to its reinsurer. D. Profit-sharing arrangements, which incentivize reinsurers to reduce risk exposure. Answer B. Catastrophe bonds, which allow a reinsurer to transfer risk to the capital markets. Explanation: catastrophe bonds, cat bonds, are used by reinsurers as a risk management tool to transfer the risk of extreme events, such as natural disasters, to the capital markets. In this arrangement, investors purchase the bonds, and in the event of a catastrophe, the reinsurer can access the funds. Option A refers to risk retention, which may limit exposure but does not transfer risk. Option C refers to reinsurance recoverables, which are amounts owed by the reinsurer to the ceding company, not a risk management tool. Option D refers to profit sharing, which is an agreement on financial terms but is not specifically a tool for mitigating extreme loss events. Question 4. Which of the following is true regarding the solvency requirements for reinsurers operating in Vermont? A. Reinsurers in Vermont must meet the same solvency requirements as domestic insurance companies. B. Solvency requirements for reinsurers are solely determined by the reinsurance treaties they enter into. C. Solvency requirements are determined by the Vermont Insurance Department and vary based on the reinsurer's business model. D. Reinsurers in Vermont are not subject to solvency requirements because they are not directly linked with policyholders. Answer C. Solvency requirements are determined by the Vermont Insurance Department and vary based on the reinsurer's business model. Explanation: Vermont solvency requirements are based on the financial strength and stability of the reinsurer, which are determined by the Vermont Insurance Department. These requirements can vary based on the business model of the reinsurer, G. Domestic or foreign. Option is incorrect because the solvency standards for reinsurers may differ from those applied to primary insurers. Option B is incorrect because solvency is not solely determined by reinsurance treaties. Regulatory authorities set these standards. Option D is incorrect because reinsurers are still subject to solvency requirements due to the financial implications of their operations. Question 5. Which of the following clauses in a reinsurance contract is designed to outline the process for determining which losses the reinsurer will cover under a facultative reinsurance agreement? A. Exclusion clause. B. Claims handling clause. C. Losses covered clause. D. Retrocession clause. Answer. B. Claims handling clause. Explanation. The claims handling clause outlines the procedures for determining how claims are handled, including which losses are covered by the reinsurer under a facultative reinsurance agreement. In facultative reinsurance, each policy or loss is considered individually, and this clause ensures clear processes for managing and settling claims. Optional exclusion clause outlines losses not covered by the agreement. Option C, losses covered clause, is a general reference but does not specify the claims handling process. Option D, retrocession clause, refers to a reinsurer transferring risk to another reinsurer and is not directly related to claims handling. Question 6. Mr. Lewis is a chief underwriter at an insurance company in Vermont. His company is considering entering into a treaty reinsurance agreement to protect against large unexpected losses. What should Mr. Lewis consider most importantly when selecting a reinsurer for the treaty? A. The reinsurer's historical performance in underwriting losses. B. The reinsurer's ability to offer competitive commission structure. C. The reinsurer's solvency rating and financial stability. D. The reinsurer's geographic location and proximity to Vermont. Answer. C. The reinsurer's solvency rating and financial stability. Explanation. The most important factor when selecting reinsurer for treaty agreement is their solvency rating and financial stability. This ensures that the reinsurer will be able to pay claims and fulfill its obligations if large losses occur. Option is less critical as the reinsurer's past underwriting performance does not guarantee future success. Option B, while important in some cases, is not the primary concern in ensuring that reinsurer can meet its financial obligations. Option D is incorrect because the reinsurer's geographic location is less significant than its financial standing. Question 7. Which of the following is true regarding the termination clause in a reinsurance contract? A. The termination clause allows for the immediate cancellation of the agreement without penalty. B. The termination clause defines the grounds and processes for ending the reinsurance contract. C. The termination clause allows a reinsurer to increase premiums if a termination is triggered. D. The termination clause is irrelevant in facultative reinsurance agreements. Answer. B. The termination clause defines the grounds and processes for ending the reinsurance contract. Explanation. The termination clause is essential in reinsurance contracts as it outlines the conditions under which either party may terminate the agreement. This ensures both parties are aware of their rights and obligations in case of early contract termination. Option is incorrect because termination usually involves a notice period and possible penalties. Option C is incorrect because termination does not allow for an increase in premiums. Option D is incorrect because termination clauses are important in both facultative and treaty reinsurance agreements. Question 8. In the context of reinsurance, what is the primary purpose of using excessive loss reinsurance? A. To share premiums and losses equally between the ceding company and the reinsurer. B. To provide a safety net for the ceding company by covering losses that exceed a certain threshold. C. To allow the reinsurer to retain a portion of the premiums for future losses. D. To manage operational risks that do not result from claims. Answer. B. To provide a safety net for the ceding company by covering losses that exceed a certain threshold. Explanation. Excessive loss reinsurance is designed to cover catastrophic or large losses that exceed a predetermined threshold, providing a safety net for the ceding company. It is not a proportional arrangement, but instead it acts as a protective layer for extreme claims. Option A refers to a quota share agreement. Option C is incorrect because excessive loss reinsurance is focused on covering large losses rather than retaining premiums. Option D is incorrect as excessive loss primarily covers risks that result in claims, not operational risks. Question 9. Which of the following best describes the concept of Risk retention in reinsurance. A. The ceding company transfers all risk to the reinsurer, leaving no risk retained. B. The ceding company retains a portion of the risk, which helps maintain its underwriting discipline. C. The reinsurer retains a portion of the risk to reduce its exposure to catastrophic events. D. Risk retention involves the use of collateral to back up the risk assumed by the reinsurer. Answer: B. The ceding company retains a portion of the risk, which helps maintain its underwriting discipline. Explanation: risk retention refers to the practice where the ceding company retains a portion of the risk, which helps ensure that they maintain underwriting discipline and have a financial stake in the outcomes of the policies they underwrite. Option is incorrect because full transfer of risk would refer to a different type of reinsurance agreement. Option C describes the role of the reinsurer, not the ceding company, in a risk retention scenario. Option D describes collateral requirements, not risk retention. Question 10. What is the primary role of reinsurance brokers in the reinsurance market? A. To underwrite policies for both the ceding company and the reinsurer. B. To facilitate the placement of reinsurance by connecting ceding companies with appropriate reinsurers. C. To directly handle claims settlement between the ceding company and reinsurer. D. To assume a portion of the risk in the reinsurance arrangement. Answer: B. To facilitate the placement of reinsurance by connecting ceding companies with appropriate reinsurers. Explanation: reinsurance brokers play a critical role in facilitating the placement of reinsurance by connecting ceding companies with appropriate reinsurers, ensuring that both parties meet their needs. They do not underwrite policies, settle claims, or assume risk themselves. Option is incorrect because brokers do not directly underwrite policies. Option C is incorrect because brokers are not typically involved in claims settlement. Option D is incorrect because brokers do not take on risk. Question 11. Which of the following statements accurately describes the difference between facultative and treaty reinsurance? A. Facultative reinsurance covers only specific risks or policies, while treaty reinsurance covers an entire book of business. B. Treaty reinsurance applies only to catastrophic risks, while facultative reinsurance applies to all types of risks. C. Facultative reinsurance involves the automatic transfer of risk, while treaty reinsurance requires individual negotiations for each policy. D. There is no practical difference between facultative and treaty reinsurance. Both function in the same way. Answer A. Facultative reinsurance covers only specific risks or policies, while treaty reinsurance covers an entire book of business. Explanation: facultative reinsurance is typically negotiated on a case-by-case basis for individual risks or policies, whereas treaty reinsurance automatically covers all policies within a specific category, often for a specified period. Option B is incorrect because both facultative and treaty reinsurance can cover a range of risks, not just catastrophic ones. Option C is inaccurate as facultative reinsurance requires individual negotiations, while treaty reinsurance is automatic. Option D is incorrect as there is a significant difference between the two types. Question 12. What is the primary goal of a reinsurance treaty? A. To ensure the ceding company receives a fixed premium from the reinsurer. B. To share the risk of loss across multiple companies in a specific geographical area. C. To provide the ceding company with financial support in case of large losses across a portfolio. D. To allow the reinsurer to assume all the liabilities of the ceding company. Answer: C. To provide the ceding company with financial support in case of large losses across a portfolio. Explanation: the primary goal of a reinsurance treaty is to provide the ceding company with financial support by transferring some of its risks to the reinsurer. This is especially useful in case of large or catastrophic losses. Option is incorrect because the treaty usually involves sharing both premiums and losses, not guaranteeing a fixed premium. Option B is too narrow as treaties may apply beyond geographical areas. Option D is incorrect because the reinsurer does not assume all liabilities in a reinsurance treaty. Instead, they share the risk. Question 13. Which of the following is an advantage of using surplus share reinsurance? A. It provides immediate financial relief for the ceding company by transferring all losses to the reinsurer. B. The reinsurer shares in a proportionate amount of the risk based on the surplus above the ceding company's retention. C. The reinsurer is responsible for paying the full premium on behalf of the ceding company. D. It is best suited for policies with very small premiums and low exposure. Answer: B. A reinsurer shares in a proportionate amount of the risk based on the surplus above the ceding company's retention. Explanation. Surplus share reinsurance is a form of proportional reinsurance where the reinsurer takes a share of the risks that exceed the ceding company's retention. The share is proportionate to the amount of surplus excess capacity available above the ceding company's retention limit. Option is incorrect because surplus share does not transfer all losses. Option C is incorrect because the reinsurer shares in the risk, not the premium payments. Option D is inaccurate as surplus share reinsurance typically applies to policies with larger risks and premiums. Question 14. What is the significance of the ceding commission in reinsurance agreements? A. It represents the amount of risk the ceding company retains in the reinsurance agreement. B. It is a fee paid by the reinsurer to the ceding company to cover administrative and acquisition expenses. C. It is a penalty that the ceding company must pay to the reinsurer if claims exceed a certain threshold. D. It is the amount the reinsurer receives for taking on the risk from the ceding company. Answer. B. It is a fee paid by the reinsurer to the ceding company to cover administrative and acquisition expenses. Explanation. The ceding commission is typically paid by the reinsurer to the ceding company to help cover the costs of acquiring business and managing administrative expenses. It is not related to the amount of risk retained by the ceding company, nor is it a penalty or payment for taking on risk. Option A, C, and D do not accurately describe the purpose of the ceding commission. Question 15. In reinsurance, what is the purpose of retrocession agreement? A. To allow the ceding company to retain risk while transferring premium payments to the reinsurer. B. To transfer some or all of the risk from one reinsurer to another reinsurer. C. To guarantee the ceding company that the reinsurer will cover all future claims. D. To define the payment schedule for claims that arise from reinsurance coverage. Answer. B. To transfer some or all of the risk from one reinsurer to another reinsurer. Explanation. Retrocession is the process by which a reinsurer passes on some or all of its risk to another reinsurer, often to reduce its exposure or improve its capital position. Option. It describes risk retention, not retrocession. Option C is incorrect because retrocession does not guarantee coverage for all future claims. Option D is unrelated to retrocession, which is about risk transfer between reinsurers. Question 16. What is the key feature of a quota share reinsurance agreement? A. The reinsurer agrees to cover a fixed percentage of losses for each policy within the agreement. B. The reinsurer pays a fixed premium for each policy covered under the agreement. C. The ceding company retains all losses up to a set threshold and the reinsurer covers the excess. D. The reinsurer covers only large losses while the ceding company retains smaller losses. Answer A. The reinsurer agrees to cover a fixed percentage of losses for each policy within the agreement. Explanation. In a quota share agreement, the reinsurer and the ceding company share both premiums and losses in a fixed proportion for each policy covered. Option B is incorrect because premiums are not fixed but are shared in proportion to the risk. Option C describes excessive loss reinsurance, not a quota share. Option D applies more to excessive loss reinsurance as well. Question 17. Which of the following is an example of proportional reinsurance? A. Excessive loss reinsurance. B. Quota share reinsurance. C. Facultative reinsurance. D. Retrocession agreements. Answer. B. Quota share reinsurance. Explanation. Proportional reinsurance involves the sharing of premiums and losses between the ceding company and the reinsurer according to a fixed proportion. A quota share reinsurance is a prime example where both the ceding company and the reinsurer share premiums and losses proportionately. Option A refers to excessive loss, which is non-proportional. Option C is facultative reinsurance, which can be either proportional or non-proportional but does not define the specific proportional arrangement. Option D refers to retrocession agreements, which involve transferring risk between reinsurers. Question 18. What does net retention refer to in the context of reinsurance? A. The total amount of risk that the reinsurer retains after a reinsurance agreement. B. The amount of risk that the ceding company retains after a reinsurance agreement. C. The total amount of premiums that the ceding company receives from all policies. D. The net profit or loss the ceding company expects from a reinsurance treaty. Answer B. The amount of risk that the ceding company retains after a reinsurance agreement. Explanation. Net retention refers to the portion of risk that the ceding company retains after applying any reinsurance coverage. This is the amount of risk the ceding company keeps for itself, while the remaining risk is transferred to the reinsurer. Option is incorrect because it describes the reinsurer's retained risk. Option C is unrelated to the concept of net retention. Option D is also incorrect, as net retention is about risk, not financial performance. Question 19. Which of the following reinsurance types is most commonly used for protecting against catastrophic losses? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Facultative reinsurance. D. Surplus share reinsurance. Answer: B. Excessive loss reinsurance. Explanation: excessive loss reinsurance is typically used to protect the ceding company from catastrophic losses by covering any losses above a specified threshold. Options or quota share involves proportional sharing, which is not focused on catastrophic events. Option C, facultative, is typically used for individual cases, not necessarily catastrophic losses. Option D, surplus share, is more about sharing risks proportionally rather than protecting against extreme events. Question 20. In Vermont, what is required for a reinsurer to be authorized to conduct reinsurance business? A. The reinsurer must have a minimum net worth of $1 million. B. The reinsurer must submit a certificate of compliance from another state. C. The reinsurer must be licensed by the Vermont Insurance Department and meet solvency requirements. D. The reinsurer must have operated in Vermont for at least 5 years. Answer: C. The reinsurer must be licensed by the Vermont Insurance Department and meet solvency requirements. Explanation: in Vermont, like in other states, reinsurers must be licensed by the Vermont Insurance Department and must meet certain solvency requirements to ensure their financial stability. Option is incorrect because the net worth requirement is higher than $1 million. Option B does not sufficiently guarantee the reinsurer's qualifications. Option D is not a general requirement for licensing. Question 21. Which of the following is an example of non-proportional reinsurance? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Facultative reinsurance. D. Surplus share reinsurance. Answer: B. Excessive loss reinsurance. Explanation: excessive loss reinsurance is a non-proportional reinsurance type where the reinsurer only pays when losses exceed a specified threshold. In contrast, quota share and surplus share are examples of proportional reinsurance. Facultative reinsurance is a type of reinsurance that may or may not be proportional depending on the agreement. Question 22. What is the purpose of a loss portfolio transfer LPT in reinsurance? A. To transfer the risk of future claims from an insurer to a reinsurer for an upfront payment. B. To share the losses from past claims between the ceding company and the reinsurer. C. To allow a reinsurer to assume a certain percentage of future claims as they occur. D. To reduce the total premium burden for the ceding company. Answer A. To transfer the risk of future claims from an insurer to a reinsurer for an upfront payment. Explanation: a loss portfolio transfer LP is a reinsurance agreement where the ceding company transfers its liabilities for a block of past losses to the reinsurer in exchange for an upfront payment. This allows the ceding company to reduce its liabilities and improve its solvency. Option B refers to sharing past losses, but it's not the main focus of an EPT. Option C describes different type of reinsurance. Option D doesn't capture the essence of EPT, which is more focused on the transfer of liabilities rather than premium relief. Question 23. What does the term retention refer to in a reinsurance contract? A. The amount of premium the reinsurer receives for assuming a risk. B. The amount of risk or loss that the ceding company retains after reinsurance. C. The amount of risk transferred to the reinsurer. D. The financial backing the ceding company requires from the reinsurer. Answer: B. The amount of risk or loss that the ceding company retains after reinsurance. Explanation: retention refers to the portion of risk or loss that the ceding company retains after the reinsurance agreement is in place. This is the company's responsibility and the reinsurer covers the rest. Option is incorrect because retention refers to risk, not premium. Option C is incorrect because the reinsurer's share is not retention. Option D is also incorrect as retention refers to risk, not financial backing. Question 24. What is the difference between treaty reinsurance and facultative reinsurance? A. Treaty reinsurance is automatic, while facultative reinsurance is negotiated on a case-by-case basis. B. Facultative reinsurance covers an entire portfolio of policies, while treaty reinsurance covers individual policies. C. Treaty reinsurance is a form of non-proportional reinsurance, while facultative reinsurance is proportional. D. Facultative reinsurance applies only to catastrophic losses, while reinsurance applies to all types of risks. Answer A. Treaty reinsurance is automatic, while facultative reinsurance is negotiated on a case-by-case basis. Explanation. Treaty reinsurance is an ongoing agreement that automatically covers a portfolio of risks, while facultative reinsurance involves individual negotiations for each risk. Option B is incorrect, as facultative covers individual risks and treaty covers a portfolio. Option C is incorrect because both types can be either proportional or non-proportional. Option D is inaccurate because both types can apply to various kinds of risks, not just catastrophic ones. Question 25. In a reinsurance agreement, what does all risks coverage refer to? A. Coverage for all types of damages except fire and theft. B. A type of policy that covers only specific risks that are stated in the agreement. C. Coverage that protects against every type of loss except those explicitly excluded in the policy. D. A form of excessive loss reinsurance covering large claims. Answer C. Coverage that protects against every type of loss except those explicitly excluded in the policy. Explanation. All risks coverage is a broad form of insurance or reinsurance that covers all types of loss except those that are explicitly excluded. Option is incorrect because all risks is more comprehensive than just covering fire and theft. Option B is wrong because all risks covers a wide range of risks, not just specific ones. Option D refers to excessive loss reinsurance but does not define all risks coverage. Question 26. In reinsurance, what is the purpose of a coinsurance clause? A. To specify the amount of the ceding company's retention. B. To share the premium between the ceding company and the reinsurer. C. To reduce the reinsurer's liability in case of claims. D. To share the financial responsibility of loss between the ceding company and the reinsurer. Answer D. To share the financial responsibility of a loss between the ceding company and the reinsurer. Explanation. A coinsurance clause is used in reinsurance agreements to share the financial responsibility of losses between the ceding company and the reinsurer. This ensures that both parties have a stake in the coverage and payment of claims. Option A describes retention, not coinsurance. Option B is incorrect because coinsurance involves loss sharing, not premium sharing. Option C is not correct because coinsurance does not inherently reduce the reinsurer's liability. Question 27. What is the primary benefit of stop-loss reinsurance? A. To protect the ceding company from large individual claims. B. To limit the reinsurer's liability for the aggregate losses incurred by the ceding company. C. To ensure that the ceding company receives a fixed amount for each claim. D. To provide the ceding company with coverage for catastrophic risks only. Answer B. To limit the reinsurer's liability for the aggregate losses incurred by the ceding company. Explanation. Stop-loss reinsurance limits the reinsurer's liability for the total aggregate losses that the ceding company faces in a given period. This protects the reinsurer from excessive losses beyond a certain threshold. Option A describes the excessive loss reinsurance. Option C is incorrect because stop-loss reinsurance is based on aggregate losses, not fixed amounts per claim. Option D is incorrect because stop-loss reinsurance is about limiting aggregate losses, not just catastrophic risks. Question 20. What is surplus relief in reinsurance? A. A financial mechanism that allows the ceding company to relieve its surplus by transferring risk to the reinsurer. B. A reinsurance agreement that automatically increases the ceding company's surplus. C. Clause that obligates the reinsurer to cover all surplus losses of the ceding company. D. Tax relief provided to the ceding company by the reinsurer in return for transferring risk. Answer A. A financial mechanism that allows the ceding company to relieve its surplus by transferring risk to the reinsurer. Explanation. Surplus relief refers to reinsurance agreements where the ceding company can offload risk to the reinsurer, thereby improving its surplus position. This can help improve the company's solvency. Option B is incorrect because surplus relief does not automatically increase surplus. It helps improve it by transferring risk. Option C is incorrect because the reinsurer does not cover surplus losses. Option D is unrelated to surplus relief in reinsurance. Question 29. Which of the following best describes the Policyholder Protection Fund in relation to reinsurance in Vermont? A. It is a fund created by the reinsurer to protect policyholders from non-payment of claims. B. It is a fund established by the ceding company to cover future losses and claims. C. It is a fund established by the state to protect policyholders in case of insurer insolvency. D. It is a fund created by the government to assist reinsurers with catastrophic claims. Answer: C. It is a fund established by the state to protect policyholders in case of insurer insolvency. Explanation: the Policyholder Protection Fund is a fund created by the state to protect policyholders in the event that an insurer becomes insolvent. This ensures that claims are still paid even if the insurer can no longer fulfill its obligations. Option is incorrect because the fund is not created by the reinsurer. Option B is inaccurate because the fund is not the responsibility of the ceding company. Option D is incorrect as the fund is designed for policyholders, not reinsurers. Question 30. What is a common use of excessive loss reinsurance in Vermont? A. To cover the risk of claims from individual policies that exceed a predetermined amount. B. To share the premiums and losses on a proportional basis with the reinsurer. C. To offer coverage for small losses and claims within a specified amount. D. To transfer specific risks from one insurer to another through a facultative arrangement. Answer A. To cover the risk of claims from individual policies that exceed a predetermined amount. Explanation: excessive loss reinsurance is typically used to protect against large individual losses by covering claims that exceed a certain threshold, usually set by the ceding company. Option B describes proportional reinsurance, not excessive loss. Option C refers to other types of reinsurance, such as quota share. Option D refers to facultative reinsurance, which can apply to individual risks but is not related to excessive loss specifically.